Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. So today we are doing a deep dive into they seem like three, totally unrelated shifts happening in global finance. You've got bond markets, corporate strategy, even crypto, and they all feel like they're playing by different rules.
Clearly do.
Our mission here is to connect the dots, to see what they have in common, and really understand what these huge structural changes mean for how you should be thinking about investing.
It's such a critical conversation to have because the old rules of thumb are, they're clearly breaking down. If your whole strategy is based on what worked for the last 10 years, you're just setting yourself up for a surprise.
Right.
We're looking at three big puzzles today. First, why are long-term interest rates so sticky, so high, even when central banks are cutting? Second, how did national security suddenly become this multi-trillion-dollar investment theme? And third, what are the mechanics behind these crazy crypto price swings we've been seeing?
It honestly feels like we're trying to trade in three different economies at once. So let's start with the one that's hitting everyone, in their mortgage rates, their retirement accounts, the yield mystery. You look at the U.S. market, and the math just doesn't add up. The data shows the Fed has already cut its short-term policy rates twice this year in 2025, and everyone expects another one soon. The goal is to get that rate down to, 3.5% to 3.75%.
Exactly. And if you're following the old playbook, say, from the 2010s, you'd think, okay, the 10-year and 30-year Treasury yields, they should be diving right alongside those cuts. But they're not.
Not at all.
They're just stuck, stubbornly high, near 4.2%. And it's not just a U.S. thing. This is happening everywhere. The European Central Bank has cut rates, 4 times?
Yeah.
Yet German bond yields just jumped. Japan's 10-year yield just hit an 18-year high.
So the short-term cost of money is going down, but the long-term cost is just refusing to budge.
It refuses.
So we have to unpack the difference here. The short-term rate the Fed controls versus that 10-year yield. What is holding that long-term rate up?
Right. So the Fed's policy rate, that's a tool for the immediate future. Think the next 3 to 6 months. The 10-year yield is a completely different beast. It's really made of two main parts.
Okay.
The first is just the market's best guess of what the short-term rate will be on average over the next 10 years.
Right.
But the second part, and this is the key to the whole mystery, is something called the term premium.
Term premium. Okay, let's use an analogy here. Make this really clear for you.
It's like this. If you lend me money for, say, 6 months, you expect some interest. Simple enough. But if you lend me that same money for 10 years, well, now you're going to demand something extra, a premium.
Right, because there's way more risk. Risk that inflation eats away at your money, risk that you, the lender, might have trouble paying me back way down the line.
Exactly. Or even the risk that you'll miss out on a better investment opportunity in year 5 or 6. That extra bit of compensation you demand for all that uncertainty. That's the term premium. And the analysis we're seeing shows 3 big risks are pushing that premium way higher right now.
And the first risk, it's all about the borrower in this case, the U.S. government itself. The sources we've looked at, like the IMF and the BIS, they are basically sounding the alarm about what one report called the absurdly large budget.
That's the heart of it. The U.S. government is running these huge chronic deficits. And to pay for them, it has to issue a constantly growing supply of bonds. So you have the world's biggest borrower just flooding the market with more and more long-term debt.
And at some point, supply just overwhelms demand.
It has to. And to convince investors to buy it all, the price has to go up. And for a bond, a higher price means a higher yield.
It's sort of like having a neighbor who keeps asking to borrow more money. First, it's $100 on $1,000, then $10,000. Pretty soon, you're going to start charging him a higher interest rate because you're just getting a little worried about his ability to manage all this debt long term.
That's a perfect analogy. That worry, that anxiety, that's the term premium inflating. The market is basically saying to the government, we need more compensation to take on the risk of this much debt.
Okay, so that's factor one. Factor two is what the report calls inflation reluctance. The market just doesn't seem to believe the inflation story.
It really doesn't. Headline inflation is way down from the peak, which is great. But the data shows that inflation expectations, they have not settled comfortably below 2%, which is the Fed's target. We can see this in the 10-year breaking rate. It's what the bond market is pricing in for average inflation over the next decade. And it's still a little bit over 2%. There's just too much long-term risk from things like tariffs, all this government spending. The market is saying, Sure, we see the rate cuts now, but we don't buy that you can guarantee 2% inflation in 2032.
So there's a debt risk premium and an inflation risk premium. And then there's this third factor, which I found fascinating. It's pure political uncertainty around the Fed's leadership.
Yeah, this part shows you just how far ahead bond investors are thinking. Fed Chair Powell's term is up in May 2026. And the analysis suggests that traders are already hedging right now against the possibility that the administration might nominate a successor who is seen as, well, more politicized or too dovish.
So the fear is that a new Fed chair in 2026 could be pressured to cut rates for political reasons, even if it's bad for the economy long term.
That is the core fear. And long-term investors aren't waiting until 2026 to react. They are hedging that future policy risk today by demanding a higher yield on a 10-year bond. They're essentially pre-pricing the risk that the Fed might lose some of its independence down the road.
Wow.
So you add it all up. Massive debt supply, sticky inflation fears, and future policy uncertainty. It's a triple threat that's basically reset the long-term price of money.
Okay, so if that kind of structural geopolitical risk is driving bond markets, what happens when it becomes a multi-trillion-dollar investment strategy? This brings us to our second big shift: national security as a core investment framework for Wall Street.
This is a sea change in how big institutions think. The huge signal was JPMorgan Chase announcing their Security and Resiliency Initiative, or SRI. They've committed $1.5 trillion over 10 years to this.
$1.5 trillion. That's a number that's hard to even wrap your head around. Is that all their own money they're investing?
No, and that's an important distinction. Most of that is what's called facilitated financing. So loans, underwriting bonds, basically helping other companies fund projects in these key areas. But, and this is the crucial part, $10 billion of it is JPMorgan's own capital for direct strategic investments.
Oh, so they have real skin in the game.
A lot of it.
Yeah.
This isn't just some press release or a marketing slogan. It's a real capital allocation theme.
And the rationale, coming straight from their CEO, Jamie Dimon, was incredibly blunt. He said, and I'm quoting here, "The illusion that the world would be perpetually peaceful has been shattered. Economic security is no longer optional."
That's the whole thesis right there. For 30 years, the mantra was efficiency, globalization, find the absolute cheapest place on earth to make something. Now that's being replaced
By resilience.
by resilience. National security is now an official investment theme, right up there with ESG or digital transformation. It's a huge pivot back towards reliability and domestic production.
So if you're an investor and you want to follow the money, where is this $1.5 trillion actually going? What's the roadmap?
They've laid out 4 key sectors. First is advanced manufacturing and supply chains. So think critical minerals, pharmaceuticals, robotics, things we can't afford to have cut off from us. Second is defense and aerospace. Pretty straightforward.
Okay.
Third is energy independence and infrastructure. So shoring up power grids, LNG, that kind of thing. And the last one is frontier tech AI, quantum computing, and especially cybersecurity.
It's a very clear list, but I think the most telling part is the very first investment they made.
Oh, absolutely. They moved fast. They put $75 million into a company called Perpetua Resources, which is a mining company based in Idaho.
Yeah.
They get a 3% stake, but it's the why that matters.
What do they mine?
They mine antimony, which is a mineral you've probably never heard of, but it's essential for defense alloys, for batteries, for flame retardants. And the reason JPM invested is that the global supply of antimony got choked off after China put export restrictions on it.
So let me get this straight. The largest bank in the U.S. is investing directly in a domestic mine, not because it's the highest return asset on the planet, but because it guarantees a supply of a mineral critical for national defense.
You've nailed it. It's the perfect illustration of the shift from optimizing for cost to optimizing for security. And look at the advisory panel they brought in. Jeff Bezos, Condoleezza Rice. This is not business as usual. This is about weaving together industrial policy, finance, and national security. Resilience is now a budget item.
It's a massive shift. So if we see this level of structural risk driving bond yields and corporate strategy, what happens when that same kind of thinking hits a market that's already, famous for its volatility? Let's pivot to crypto and the wild moves we've seen in Bitcoin and Ethereum.
Right, and this gets us to the idea of a short squeeze, which is just so vital to understanding these markets now. For anyone listening who's new to this, a short position is really simple. It's just a bet that an asset's price is going to go down.
You're betting against it.
You're betting against it. You borrow it, you sell it, and you hope to buy it back cheaper later.
But the risk is what if you're wrong? What if the price goes up?
If the price goes up instead of down, you start losing money fast. And to stop the bleeding, you have to buy the asset back to close out your bet. We call that covering your short. Now, imagine a situation where way too many people have made that same bearish bet.
The market is overcrowded with shorts.
Exactly. So a tiny little move upward can cause a few shorters to panic and buy back. That buying pushes the price up a bit more, which forces more shorters to panic and buy back.
And it just creates this feedback loop, this cascade of forced buying that sends the price rocketing upward way faster than normal demand ever would.
It's like a crowded theater with only one exit. The first sign of smoke, and everyone stampedes for that same door at the same time. That panic is the squeeze. And recent data showed something like $10 billion worth of Bitcoin short positions were all clustered around the same price levels. It was just fuel waiting for a match.
And we saw that match get lit in early December. Hundreds of millions in forced liquidations in just a few hours. And that just kept feeding the upward momentum.
It did.
Yeah.
And if we zoom out, the crypto market is in what some analysts are calling a double-sided wipeout environment. The volatility is just brutal in both directions. And that's because there are two powerful conflicting forces at play.
A conflict. What's the conflict?
Well, on one side, you have a pretty solid floor under the market. This is what we call the heavy money, the long-term institutional demand coming from things like the regulated U.S. spot ETFs.
So that's the big, slow-moving money.
Right. And the total holdings in those ETFs are still near all-time highs. That provides a strong structural support level. It stops prices from just collapsing.
Okay, so you've got a firm floor from the institutions, but at the same time, you have this incredibly unstable ceiling created by all these short-term traders using way too much leverage.
You've got it. So you have a solid floor, but then you combine it with thin liquidity, which is common at the end of the year, and these huge over-leveraged short positions. The market becomes a pressure cooker. Any little piece of good news, a small inflow into an ETF, some positive talk about the Fed, it can set off one of these massive squeezes.
So it's not about the old simple narratives anymore, like money printing equals crypto goes up.
Not at all. It's now all about the internal market structure, the ETF flows, and this insane leverage. It means risk management, especially keeping your own leverage low, is everything right now.
So if we try to synthesize these three areas, the sticky bond yields, the national security investment framework, and this leveraged crypto market, it seems like they're all telling us the same story.
They absolutely are.
Structural risks are now in the driver's seat, and they're overpowering those simple short-term policy moves from central banks. Things like government debt, supply chain security, market leverage, those are the forces shaping everything.
You're spot on. The world has fundamentally re-rated risk. Institutions are demanding more compensation for taking on debt risk, for political uncertainty, for supply chain fragility. The simple formula is rate cuts mean stocks go up. You can't rely on those anymore.
Which means the most fundamental calculation you make as an investor has been permanently changed. And that brings us to our final thought, something for you to really think about. If the U.S. 10-year yield has structurally reset, if it's moved from that 0 to 2% range that fueled the entire tech boom for a decade, up to a new normal of, say, 3 to 5%, how do you have to change the way you calculate the true value of a high-growth company today? Think about AI stocks, or any company whose profits are far off in the future. When you discount those future profits back to today's value, you have to use a discount rate. And when that rate goes from 1.5% to 4%, the present value of those future earnings just collapses. That higher structural cost of capital changes absolutely everything about what you should be willing to pay for growth. Don't forget to subscribe and hit that like button.